Today on Charged Alpha, we're covering Zillow Group, the company that put the Zestimate in everyone's pocket and became America's default starting point for home search.
Zillow is a real estate marketplace, not a real estate company. It connects buyers, renters, and agents. It does not own properties. That distinction is central to the business model.
The company was founded in 2004 by Rich Barton and Lloyd Frink, both Expedia alumni. Their core insight: home values were being hidden from buyers by the industry. Zillow would make that data public.
In 2006, Zillow launched the Zestimate, an automated estimate of home value for virtually every U.S. property. Real estate agents hated it. Consumers loved it. It became the brand's defining product.
Zillow went public in 2011, acquired rival Trulia in 2015 for $3.5 billion, and became the dominant online real estate search platform. Then in 2018, it made a major bet on iBuying.
Zillow offers bought homes directly from sellers and resold them at a profit. The algorithm mispriced the market badly. Zillow shut the program down in 2021, taking over $500 million in losses.
That failure forced a pivot. Zillow refocused on its marketplace roots. The super app strategy integrates home search, agent referrals, and Zillow Home Loans into one connected platform.
On the business model, Premier Agent is the largest revenue line. Real estate agents pay for leads and placement on Zillow Search. It is an advertising model at its core, with gross margins above 70%.
Rentals is the second revenue driver. Zillow Rentals competes with Apartments.com and diversifies Zillow beyond the cyclical for-sale housing market.
Zillow Home Loans, the mortgage origination arm, is the third leg, smaller today, but strategically important. Capturing the financing step means capturing far more of the overall transaction value.
Competitively, Zillow's primary threat is Redfin, which also operates as a brokerage. CoStar Group's Homes.com is a well-funded challenger. Opendoor remains in the iBuying space that Zillow vacated.
Zillow's moat is its brand and its data depth. The Zestimate covers over 100 million U.S. homes. That data asset, updated continuously with transaction and listing information, is extremely difficult to replicate.
Geographically, Zillow operates across all 50 states. Its strongest markets are Sunbelt metros like Phoenix, Dallas, and Miami, alongside gateway cities like New York, Los Angeles, and Seattle.
On leadership, Jeremy Waxman became CEO in August 2024, succeeding co-founder Rich Barton, who moved to executive chairman. Waxman had been with Zillow since 2009, serving as CMO and then COO.
He built Zillow's brand, oversaw rentals expansion, and has been central to the super app strategy since its inception. This is an operational promotion, not an outside hire.
Waxman takes over at a pivotal moment. Zillow returned to profitability in fiscal 2025 for the first time in several years. Whether the super app strategy can sustain that is the core question.
The Q1 2026 results are in. Zillow's revenue trajectory and mortgage attach rate are the metrics to watch in one of the most interest rate sensitive business models in tech.
We break all of it down in the full earnings episode: the numbers, the housing market context, and what analysts are watching most closely for Zillow's path to durable profitability. That is next.
Zillow Group reported Q1 2026 revenue of $708 million, up 18% year over year and near the top of its guidance range, but slightly below some analyst estimates. Adjusted EPS of 19 cents significantly beat the 11-cent estimate. Rentals grew 42% and mortgages grew 56%. The stock fell 8% after hours on the revenue shortfall. This is Charged Alpha. I'm Hudson.
And I'm Lana. Zillow Group operates the leading U.S. real estate marketplace, connecting buyers, sellers, renters, and mortgage seekers. Revenue comes from three segments: residential, which earns Premier Agent advertising fees from real estate professionals; rentals, which monetizes multifamily listings; and mortgages, which originates purchase loans. Zillow's super app strategy integrates home search, mortgage origination, and transaction workflow in one platform. Market cap is approximately $16.8 billion.
CEO Jeremy Waxman, who took the role in 2024, has accelerated Zillow's integration of its home search and mortgage platforms. Waxman's operational focus is converting Zillow's massive buyer traffic advantage into mortgage origination market share, linking the search funnel directly to purchase loan applications. The Q1 results reflect both the success of that strategy in mortgages and the ongoing headwinds in residential from a suppressed housing transaction market.
Zillow's Q1 2026 revenue of $708 million grew 18% year-over-year, near the top of Zillow's own guidance range for the quarter. The $12 million shortfall against some analyst estimates drove the after-hours stock decline. Net income was $46 million, producing a net margin of 6%, a 520 basis point improvement year-over-year.
Adjusted EPS of 19 cents significantly beat the 11-cent estimate, reflecting operating leverage as the rentals and mortgages segments scale. Adjusted EBITDA was $182 million, with an adjusted EBITDA margin of 26%, flat year-over-year despite a 160 basis point headwind from incremental legal expenses. The margin resilience is a positive signal for operating efficiency.
Rentals revenue grew 42% year-over-year to $183 million in Q1, with multifamily revenue up 57%. The rentals segment is benefiting from apartment inventory growth, higher digital advertising adoption by property managers, and Zillow's expanding data advantage in the rental search market. Rentals is the segment with the most consistent growth trajectory across the last 4 quarters.
Mortgages revenue grew 56% year-over-year to $64 million, driven by a 96% increase in purchase loan origination volume to $1.5 billion. Zillow's mortgage strategy is to originate purchase loans for buyers who start their home search on Zillow, converting search traffic into revenue without depending on the broader refinancing market. The 96% volume increase confirms the conversion funnel is working.
Residential revenue, premier agent advertising fees paid by real estate agents, grew only 8% year-over-year to $450 million. Residential is Zillow's largest segment, but its slowest growing, reflecting the soft housing transaction market. With existing home sales still significantly below historical norms due to elevated mortgage rates, agents are spending more cautiously on lead generation platforms, including Zillow's Premier Agent program.
Operating cash flow nearly doubled year-over-year to $200 million. Adjusted free cash flow grew 44% to $127 million. Zillow holds approximately $2.4 billion in cash against $1.8 billion in debt, a net cash position that provides flexibility for share buybacks, strategic acquisitions, or continued platform investment without balance sheet pressure.
Analyst reaction to Zillow's Q1 was mixed, reflecting the split outcome. EPS beat, revenue narrow miss, stock decline. Oppenheimer maintained outperform, emphasizing the EPS beat and improving profitability. UBS and Wedbush maintained neutral ratings, citing the revenue miss and soft residential segment as near-term overhangs. The consensus view is that Zillow's long-term story is intact, but execution faces a housing market headwind.
The housing market recovery timeline is the central debate. Bulls model mortgage rates declining towards 6% by late 2026, unlocking pent-up seller inventory and driving existing home sale volumes back toward historical norms. In that scenario, residential revenue re-accelerates, and Zillow's 18% growth rate would be a floor rather than a ceiling. Bears model rates staying elevated, keeping existing home sales suppressed, and residential growth in single digits.
The rentals and mortgages growth story is less debated. Both segments are executing well. The strategic question analysts are modeling is whether rentals and mortgages can offset a prolonged residential slowdown and sustain 18+% revenue growth. Q1 suggests yes. The 42% and 56% growth in those segments absorbed the residential deceleration and still delivered near top of guidance revenue.
CoStar Group's Homes.com is the competitive threat analysts track closely for residential. CoStar is investing in real estate marketplace advertising, including a Super Bowl campaign, to challenge Zillow's Premier Agent dominance. If Homes.com successfully diverts agent advertising spend from Zillow's platform, residential ARPA growth could disappoint. Bulls argue Zillow's traffic advantage is too large to displace quickly. Bears model CoStar gaining meaningful share by 2027.
The super app integration thesis is the long-term catalyst analysts are monitoring. Zillow's strategy is to capture a share of the buyer's mortgage transaction, not just the search interaction. Q1 purchase loan origination volume of $1.5 billion, up 96%, proves the funnel works. If Zillow achieves mortgage origination market share consistent with its search traffic share, the total addressable revenue opportunity expands by multiple billions annually.
The bull case for Zillow is housing market recovery and super app expansion. If mortgage rates decline toward 6%, existing home sale volumes could recover toward 4 to 5 million annualized. Each 1% increase in transaction volume represents meaningful residential revenue upside. Layered with mortgages scaling, bull case revenue for 2027 could approach $1 billion quarterly.
Zillow's traffic monopoly is underappreciated. Zillow and Trulia together command more monthly visits than all real estate competitors combined, a traffic advantage that took decades to build and cannot be replicated through advertising alone. This audience scale gives Zillow Premier Agent pricing power and a built-in mortgages and rentals funnel that competitors cannot match without equivalent brand recognition.
The rentals segment has a long runway. Apartment inventory is at multi-decade highs from the 2023 and 2024 construction boom. Property managers with more units to fill are spending more on digital advertising. Zillow's multifamily revenue grew 57% in Q1, a pace that could sustain double-digit contributions to revenue growth for several years, independent of the for-sale market.
The bear case centers on residential deceleration. Premier Agent revenue growing only 8%, while the broader digital advertising market grew faster, suggests Zillow is not outgrowing its category. If mortgage rates stay elevated and home sales remain near historical lows, residential, the highest margin segment, grows slower than total revenue, compressing margins.
CoStar's Homes.com is a structural threat to Premier Agent pricing. CoStar has reported spending hundreds of millions to build Homes.com brand awareness and agent relationships. A sustained multi-year investment creates a credible alternative for agents who want to reduce dependence on Zillow. Pricing pressure on Premier Agent contracts could emerge by 2027.
The revenue miss, even at $12 million, signals that consensus estimates outpace the actual housing market recovery trajectory. Q2 2026 guidance is the key watch point. If Zillow guides below consensus for Q2, the stock faces additional pressure as investors recalibrate the recovery timeline. The 8% after-hours decline reflects guidance risk more than Q1 results.
Mortgage originations are still small relative to residential. $64 million in mortgage revenue versus $450 million in residential means even 60% mortgage growth does not offset a 20% residential deceleration at the company level. Until mortgage origination revenue reaches $200+ million per quarter, Zillow's overall revenue trajectory remains primarily driven by housing market conditions, not segment mix optimization.
Redfin is Zillow's direct marketplace competitor. Redfin operates as both a brokerage and a marketplace, directly employing agents and competing for buyers and sellers. Redfin's model has faced profitability challenges, but its integrated platform represents a differentiated approach to capturing more transaction commission. Redfin's Q1 results will provide a comparison point for how the broader housing market is tracking.
CoStar Group is the competitive threat rather than a direct peer. CoStar's Homes.com residential marketplace, funded by CoStar's commercial real estate data monopoly, is targeting Zillow's Premier Agent business with significant marketing investment. CoStar's commercial real estate revenue gives it the staying power to fund a multi-year residential marketplace challenge.
Opendoor Technologies operates as an iBuyer, buying and selling homes directly. Opendoor's model is cyclical and capital-intensive, making it a different investment than Zillow's asset-light marketplace. The comparison shows the spectrum of real estate tech business models, from asset-light marketplaces like Zillow to capital-intensive operators like Opendoor, and explains why Zillow commands a higher valuation multiple.
On valuation, Zillow trades at 89 times trailing earnings and 6 times revenue, a premium reflecting its traffic monopoly and super app optionality. The multiple compresses if housing recovery extends beyond 2026. It expands if mortgage origination scales to 15+% of revenue, moving Zillow from a marketplace to a fintech-enabled real estate platform.
Zillow's options market ahead of Q1 showed elevated implied volatility, consistent with binary outcome potential of a real estate tech company reporting into a housing market uncertainty. Pre-earnings positioning was balanced between calls and puts, reflecting the split outcome risk. The 8% after-hours decline was at the high end of the implied move range.
Post-earnings options flow shifted toward near-term put protection as the stock declined in after-hours trading. Traders who positioned for an upside move on the EPS beat saw gains partially offset by the revenue shortfall-driven decline. The Q2 guidance outlook will be the data point that determines whether put skew in options pricing resolves or extends into the summer.
Insider activity at Zillow reflects the co-founder equity structure. Rich Barton, co-founder and former CEO, holds significant equity through Class A and Class B shares, providing long-term alignment with shareholder interests. CEO Jeremy Waxman has been building his equity position through restricted stock units since assuming the role. No open market purchases were disclosed in the last 90-day window, consistent with management focus over speculation.
The combined read from options and insider data is neutral. The market correctly anticipated post-earnings volatility. Insider equity structure, with co-founder involvement and management RSU programs, aligns leadership with long-term value rather than near-term performance. For long-term investors, the 8% after-hours decline may represent an overreaction to a revenue miss in a housing market quarter.
Zillow delivered Q1 2026 EPS of 19 cents, significantly beating estimates. With strong rentals and mortgages growth, the stock fell 8% on a narrow revenue miss and residential segment softness. Q2 guidance is the next key catalyst.
Bottom line, Zillow is the real estate marketplace leader with a growing super app. The bull case is housing market recovery and mortgage origination scaling. The bear case is CoStar competition and prolonged residential deceleration. The Q1 EPS beat is the silver lining in a mixed quarter.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.